All right, everybody, welcome back to the Sense of Things podcast with Ron Lang and Jeff Kikel. Really excited today to start to really dig into a little bit less of the current, what's going on in the markets, and really get to the point that we've wanted to get to for a while here as we've started this, really start to educate you on what's going on behind the scenes in some cases on the markets. And so, Ron, welcome to the show today. Good to see you, my friend.
Morning, Jeff.
Morning.
It's been an interesting, but also kind of a moderate news week since our last podcast.
Yeah, it's kind of quiet this week. I think the only thing of interest was CPI, and it was kind of meh.
What were your thoughts on it overall? I mean, I know it came down a little bit, but certainly wasn't anything to wave a flag about.
No, it's one of those things that it keeps kind of slowly eking its way down. I mean, I think what came out of it was exactly what you and I talked about a month ago is, energy prices were going to pop up most likely because, the Saudis and OPEC decided to cut back on production. So, okay, we saw that pop up a little bit. I think the other thing I pulled out of it is the housing side of things is still stubbornly, fighting it. I was reading a little article this morning where they talked about it that, over 2020 or 2020, 2021 and 2022, we had that huge rise in the in the housing costs or housing prices, and that's still being absorbed into the rental market, which really mostly affects this number. So I just think it's just not going to come down anytime soon, no matter what the Fed does.
It's interesting you said that because I've been following the housing market out here, at least in the Phoenix area, and there are pockets in areas houses cannot sell.
Yeah.
And then you go to some other areas and they're not on the market more than a few days or a week. It's very interesting, just kind of like the difference in the overall market itself. And then you got parts of the country that prices are coming down every week. So, the infamous thing with real estate, right? Location. But, certainly, people that are in interest, have interest rate mortgages under 4%. If they want to move, they're not going to move to get a mortgage that's close to 7%.
Yeah. Well, and that's, I was just did a podcast with a good friend of mine. We do a local podcast here in the Austin area called the Austin Top Guns podcast. And Richard, my co-host, is a realtor, and he was discussing that same thing. He said, trying to get people to move, getting listings now, unless they have to move because of a job change, they're just not moving. And people aren't going from, okay, well, our family's kind of outgrown this place to, oh, we're going to step up, because they're looking at, okay, I've got a really low mortgage. We're just going to have to make it work for now.
Right. Or they're putting money into their house, right?
Yeah.
Instead of saying, well, house isn't big enough, could do this, could use that, instead of moving, they're putting, they're doing it yourself.
Yeah. Yeah. And do it. And they're, I think people are getting shocked by contractors. I was having a conversation with a contractor yesterday, and she said, she's talking to a real estate investor that was updating some of her real estate properties down south. And, she's like, oh my God, you're so expensive. And she's like, no, that's basically what the prices are now to get stuff done. I mean, it's prices have gone up significantly. Materials are still up there. They haven't come back down drastically. I mean, they've come down, but not near what they were, 3-4 years ago.
A construction client of mine about 6 months ago basically said that he was telling people, if you want anything significant done, it's going to be at least 6 months out before he could even get to it, because he is hiring, but he doesn't want to double or triple his staff in order to do that. The second thing is, now he said, look, if it's not at least a $10,000 job, he's not going to do it, because he's looking at larger projects instead of a lot of smaller projects. So he's got to basically go for the more profitable projects right now, and he can't even get to them for at least 6 months. I don't know how long that's going to last, but certainly, like I said, people are putting money into their own houses versus moving and buying.
Yeah, and I think it's going to continue to be that way. I mean, it's been that way for the last 3 years, and you wonder where people finally hit that wall of, okay, we can't really do anything more with our house. But I don't see it ending anytime soon. And the contractors I talk to are, they're all just like him. It's at the bare minimum, it's 4 to 5 weeks to even get started on your project, and it could be 5 to 6 months depending on how complicated the project is. So,
yeah, and I think we're going to see that right through the summer and into the fall.
Yeah, I totally agree. But I think the only thing that's going to slow it down is some kind of a recession that we might see down in the future. But who knows when that's going to happen at this point.
So here's a question for you. I had a good debate yesterday with somebody. So we saw what happened in March, where look, we're both looking for a pullback. I mean, I know that's the general consensus, at least as I'm concerned, along the smart people with the market. And the catalyst back in March for a pullback in the market was the banks.
Yeah.
Now, once the government came in and did what they did, the market popped back up again, but it can't get over certain levels, which we'll talk about towards the end of this. We need another catalyst to pull the market back.
Yeah.
What do you think that catalyst is? I think it's going to be another banking. I think that's going to be what it is. And then more faith will be lost, either justifiably or unjustifiably so. What do you think the catalyst is going to be to say, okay, all these economic numbers have lined up the way we've all seen it for an eventual recession? What do you think it is?
I personally think it's going to be this whole the whole debate over the budget and trying to get that, the debt ceiling piece of it. I just think, just listening to the parties this week, after the meeting in the White House, everybody's dug their heels in, and it's like a big ginormous game of chicken right now. And I think that could be the catalyst that finally throws us over the hump. Because if the federal, no matter what the Fed does, if the federal government just keeps spending money like drunken sailors and they put no brakes on any of that stuff, I mean, they're just going to keep fighting each other. And Powell and the Fed are just going to keep doing what they've been doing, which is, okay, we're going to sit there and see what happens for a few months, and then they'll, if they see inflation starting to continue to rise, they're just going to jam, they're just going to jam more interest rates down our throats until they break the back of it, which is going to throw us into a recession at that point.
Because I think we do have another rate hike in June. The problem is, if the debt ceiling has not been resolved, I don't know that they can do a rate hike in June.
I just
They've done 10 in a row.
Yeah.
I don't know if it'll be 11 if they don't get the debt ceiling resolved.
I just don't see that happening until the fall. I think until that gets resolved, I think the Fed is going to sit on the sidelines a little bit. I think they are starting to look at the banking situation, but once again, it's like out of sight, out of mind. I haven't heard anything about the banks in, 2 weeks watching the news. We had that whole big thing, I think the last one was First Republic, Chase taking over the deposits of First Republic. And then I've heard nothing really in the news since as a result.
PacWest Bank, Western Alliance, they're still out there. I think they're teetering. Who knows? I mean, when confidence is gone in the bank, it's gone. It doesn't come back.
Yeah.
So there's going to have to be some M&A in there, not really sure. But it's funny you said that about the Fed rate, because the Fed board has held very steady about the rates either going up or remaining high into 2024.
Easily.
But the Fed futures market is showing a rate cut in September and October and through June of next year. Now, the only way that could happen is if we are in a significant recession by the end of the summer. I don't know, what you deem as significant. I don't see that happening. Or number two, something catastrophic happens, which we don't want to see, you know, either geopolitically or something else. I have no idea how they could raise rates in May, possibly in June, and then start reducing them in September and October.
There's not a chance.
I don't see the logic in any of that.
Yeah, there's not a chance of them doing that, because I mean they're really caught between a rock and a hard place, because if they continue to raise rates, then they could easily throw us into a recession. You know, if they lower rates, you could easily throw ourselves into stagflation at that point, which they don't want. And I personally think we're already kind of in stagflation. We're in this weird world where it's like, okay, if we raise rates, it slows the economy down, but inflation still stays high. If we lower rates to get out of a recession, we could accelerate in, you know, we could accelerate inflation farther and exacerbate the situation. So it's a tough situation to be in from a monetary policy perspective, and you don't have the Fed coordinating with the administration, you know. And so you've got the legislative branch, or you've got the, you know, the executive branch that's just, okay, we've got to do this. So you got the other ones, you know, doing this, you got the courts doing this, and nobody's really coordinating anymore with the Fed. And, you know, I think the Fed's going to do what they feel like is their mandate, which is, you know what, we got to slow this thing down. We got to get back to 2%, which I don't think there's a chance in hell of that ever happening.
3 to 5 years out easy.
Yeah. And I mean, things are going to have to get uber bad to get it down to 2%. I'm sorry. It's just not going to happen. But, you know, I mean, I think we're at a point where it's like, okay, until something starts to happen where everybody goes, oh crap, we've got to kind of get on the same page again, it's just not going to happen. And I feel like the executive branch and the legislative branch are just, you know, at loggerheads, and they're not going to, you know, nobody wants to deal with each other. And, you know, you've got the president saying, well, I'm not going to deal on anything. You just have to pass it. Well, screw you. I'm not going to pass it. We passed something, you know, and I think what the Republicans passed is, you know, okay, it's something, but I think they passed it to say, okay, let's deal. And then nobody wants to deal. And so
look, it's been a political football for decades. Yeah. It doesn't matter who's in the White House or who's in control of the Congress.
It's always the same thing.
Look, as we do these things, we get closer to June 1st. Yeah. You know, it's going to become more of a blood sport anyway, which I think the politicians enjoy.
Yeah, well, I think they do. And then they go into, you know, I mean, they hit the summer. I mean, it always seems like this happens right before the summer. Then they decide, well, we're going to go on vacation for a month and we're just going to let this thing drag out. And like I said before, you know, then they play all the stupid games of, oh, well, we're going to close half of the national parks and, you know, half of the monuments and all this idiotic stuff, when it's like, okay, you guys need to deal with this.
Right.
It's your jobs to deal with this and come up with a solution.
Well, the one thing I don't hope they do, then we can move on, is I'm hoping they don't just kick the can down the road to September. You know, that's ludicrous. Yeah. You know, they've got to come up with something. And when they both draw a line in the sand, it gets difficult. I know we said last time, every day that goes, we get closer. I don't think we'll have a default. I think we may have a government shutdown.
Oh,
I think we're getting closer to that. We may even be closer to 80% to a potential government shutdown. So we shall see.
Yeah, which is going to just cause havoc. I mean, I've talked to my friends in the mortgage, you know, side of the house, and I mean, that's what ends up happening is, you know, oh, we have a government shutdown, and then all of a sudden it trickles down through the economy, and it just makes it impossible to do business and everything else if you have to do anything with the federal government. So, you know, that said, guys, get your butts in gear and actually get some. Yeah, we pay you to be there, get some stuff done. You know, you're there to negotiate and come up with a solution. And you know, I like I said, I think it's a game of chicken right now, and one of them is going to blank at some point, or one of them is going to turn at some point. But I think they could drag this out for several months if you know, if
Ooh, don't say that. Yeah,
I
hear you.
I know, but I know how things work, and it just seems like this time people are less and less likely to work together, and it's, you know, each of them is going to try and use it for their political gain, you know, going into the next cycle here and, you know, a year down the road.
Shall see.
So on fun times, let's switch gears a little bit. Let's talk about how the hell we build indexes in this country, and what you know, how those index, what the movement of those indexes actually means.
Yeah, you know, it's interesting. You know, clients are like, hey, the market was up 10%. My portfolio was only up 9, or, you know, whatever the case may be. And what is a good index? And a lot of people, I don't think, understand how it works. And, you know, obviously in a short time frame today, it's tough to do a deep dive, but I'll tell you what, let's just go through a couple of very quick things. And I think from that standpoint, maybe we can better understand it. So the big difference between the Dow and the S&P index is that the Dow is price weighted. So a stock that's $30 will move the index less than a stock that's price weighted $150. It doesn't make any sense. Now the S&P is market cap weighted. And as you can see here, now this is through the end of March, first quarter of this year as far as total returns. Here's the interesting part about this. You know, the year-to-date total return was 8.3%. But as you can see, the top 10 largest stocks were up 6%, and the other 290 were only up 2.3. Now, are those top 10 stocks truly a representation of the entire market? I don't think so. You know, this is the crazy thing. Apple and Microsoft together, their market caps alone is $5 trillion. That's bigger than many countries' GDP in the world. Two companies, two stocks. So does Apple and Microsoft truly represent, you know, the United States economy? The answer is no. But, you know, people want to look at that because it's the consumer, and our economy is 2/3 to 3/4 driven by the consumer. So, you know, they both produce consumer-oriented products. Obviously, the same thing with Amazon, Google, so on and so forth. So it should be interesting to see the way this pans out. So what should you be looking at as a benchmark? Depends on what stage you are in life. Are you in the accumulation stage? Well, maybe the S&P 500 is good for you. If you're in the pre-retiree or the retiree stage, you're probably looking at something that's more balanced, you know, between growth and fixed income, because you're looking for stability in your portfolio. So we could probably do a podcast in the future of different benchmarks to look at, but a lot of people should really understand that the Dow and the S&P, you really shouldn't be benchmarking your portfolio against either one of those indexes. Obviously, it's always in the headlines, but it is something to kind of look at and consider. You know, here's the other crazy thing with the S&P 500. You know, of the makeup of it is almost 26% is just technology. You know, almost 14.5% is healthcare. Now, rather ironically, in 06 and 07, the financial sector was the largest.
That's what I was just about to say, is like, if you looked at
crash, that was like what, 25% of the S&P 500.
It was basically
so you can see on the bottom that just Apple and Microsoft, two stocks out of 500, make up 14% of the S&P 500. So interestingly enough, a lot of people have said, well, you know, over the years, you know, has it always been 2 or 3 or 5 stocks that have really made up the move? And just very quickly going through this, I thought this was a great chart. 1980, you know, IBM was always, you know, you can't go wrong forever hiring IBM. Well, here they were, like they were the #1 stock for many years, even prior to 1980. And you could see how things evolved. General Electric was big until they weren't. Exxon was the biggest until they weren't. And then when Apple obviously did all their products, and, you know, in the late 90s and into the 2000s, they are now obviously the larger company, have just gotten bigger and bigger and bigger. And you know, if you can see here, right? Apple, IBM and General Electric, right? Two big stocks since 1980. By 2015, IBM was off of this, and by 2020, GE was off of it. So, you know, things, what goes around comes around, but it should be interesting to say which way it goes down the road. And, you know, this is the other really quick chart I wanted to go through, and that is, you know, people want to look at, well, when you have a really bad year, what does the next year look like? Only once, right, in the last 50 years did only once in the last 50 years, only once did a bad market follow a bad market year. So what should this year provide? Again, this is the NASDAQ. These are the top tech stocks. The tech group, the NASDAQ, for the most part, has been up big this year so far. Will they continue after a bad year? We'll have to see. And I know you want to talk about high frequency trading or the high frequency in the market through First Trust. So let me turn it over to you. But I think some of these stats are very important to know.
Oh, yeah.
You know, tech typically leads the way. They may lead the way this year, but will they lead it going into 2024? We'll see.
Yeah, no, I totally agree with you. And I think, one of the things that I was looking at when, I think you and I were talking about this at the beginning. Yeah, one of the things I was looking at was, can you unshare for just a second? Hang on. Let me share my screen here.
Yeah.
Quick. Hang on, let me find my chart.
Oh,
here.
stop share. There you go.
There we go. All right. So one of the things I watch on kind of a regular basis, and this is something that one of my favorite sources of information is First Trust. I think they were just awarded the most accurate economic forecast in 2022, and they are always right on the money. But they started putting out during COVID this high frequency data tracker. Yeah. So it's something I love to read through. It's a quick read, but it's really fun to kind of take a look at this of, where we were before the pandemic in 2019, and then where are we now? And so they started doing this to kind of benchmark, okay, where are we at? And so, one of the things they put out is this chart, and it's interesting to see, 2019, we've had a massive recovery in the markets, massive recovery in the economy, but really in a lot of cases, we can start to see some of the changes that are happening or that have happened over this time period. I think the things that really stuck out to me kind of somewhat shockingly, box office receipts, they were $257 billion in 2019.
Yeah.
This, as of, year over year, 2023, only 122, so down 52%. And I mean,
and it's going to keep going down.
Yeah. And I mean, we were talking about this before. I mean, how many movies do you really want to go to the theater to see anymore? And I mean, it's changed drastically. They've adapted the theaters, with comfortable chairs and, some in Austin here, we have, one of the movie theaters really, I mean, they're a movie theater, but they have gourmet food and a bar and everything else. So they've tried everything to drive people in, but it's just not happening.
It's tough to pay $25 to go see a rom-com that you're going to drink beer and be served food.
Yeah. And I mean, the reality is, okay, how many Marvel superhero movies can you see? I mean, I've lost track of how everything's all connected and all that anymore. They used to make sense. Now it's just, okay, let's make as many movies as possible.
Oh, it's oversaturated.
Yeah. And just not really interesting new ideas. So yes, I think Hollywood's kind of shot themselves in the foot. But I think this says a lot about, people decided, I've got more options now through streaming. I don't have to go to the theater. I can sit in my house. I can do all that. We can have watch parties. And, if we want to watch a movie, and good movies are only lasting a couple weeks in the theater at this point. So that I thought was really interesting for me. One of the things that I saw out of this, we're basically back to where we were like on TSA checkpoint data. So more people are traveling. The biggest thing on this was we actually hit a global commercial flights. We hit a record, highest ever after the pandemic now of global commercial flights, 121,354. So that's 6% above where we were a few years ago. It's significantly more. And when we get down into this, and I'm going to kind of expand these out a little bit here. I don't think I was anything interesting there. One of the things that I saw in this, and this was kind of intriguing to me, when we look back, 2021 is the black line here. 2019 is the gray line. So 2019, that's our standard bearer. This was retail sales, weekly retail sales in 2019. Well, the orange line, of course, is COVID. So, I mean, we shut our total economy down, but really by the end of 2020 or 2020, we were right back to where we were before. 2021 was kind of this, hey, we're all getting out, we're doing things again. But it's intriguing to me that retail sales are really trending downward in 2023. So that's showing that maybe it's having some effect on the consumer, where the consumer is pulling back. But here's the interesting
scroll up to the jobless claims. There was something interesting there. Actually, well, go up to the top for the numbers.
Okay.
And there's a reason why I'm going to bring this up. So I thought this is interesting. So compare the continuing jobless claims, right? 2019, 1.6 million.
Yeah.
I believe the unemployment number was like 5.1, 5.2, somewhere in there. Here we are, more
3%.
Jobless claims, but our unemployment rate is 3.4, 3.5.
Yeah.
So what people don't understand is this includes people that have retired, people that have left the job market, don't want to work or whatever. So that's why that unemployment number, liars figures lie. You could tweak it. You can't tweak these numbers, right?
No.
These are truly the jobless claims. So there's definitely more retrenchment going on. I just saw a number yesterday that National Small Business, a survey that they are now laying off more people, but you don't hear about that because you only hear about, the top 100 market cap companies when they're making major layoffs. But if small business is starting to lay off people, that's not a good sign.
No, or they're either not laying off. I mean, I think the other really big one was if you looked at the JOLTS numbers, so the job openings, blah, blah, whatever the index is, the JOLTS number went from a high of 12 million jobs open. So this was just open jobs out there that, anybody could go get theoretically. That JOLTS number over the last 4 months has gone from 12 million down to about 9. It's like 8.8 million all of a sudden. So yes, there's still 8 million jobs open, but the problem is there's a massive skill gap in that. You've got a lot of people who are looking for work that aren't qualified for a lot of the jobs that are out there. And I think that 4 million job movement is most likely in smaller companies that are saying, you know what, we're just going to make do with the people that we have at this point. And it's the really low skill jobs that nobody wants to take. Well, yeah, those, there's hiring all over the place. So that's a big part of that 8 million number, but there's a big skills gap difference. I was talking to one of my friends that's a recruiter and HR consultant, and she was saying, just in their world, trying to find the qualified people to fill jobs it's very difficult. And if you're using, as a small business owner or any owner, you're using one of the major the major sites, it's hard to find people because they're not getting to you. So, we had retail weekly sales. This was the other one that was interesting to me. TSA checkpoint data. So we start to look at that. I mean, we're right back to where we were in 2019 when it comes to TSA checkpoint data. So that tells me, okay, I'm cutting back on what I'm buying, but I'm not giving up on my vacations at this point. And if you look at global commercial flights, we're trending way above.
Yeah.
So, anything related to travel and, people experiencing things, that's not, that hasn't been affected yet.
The consumer's still spending.
Yeah. Mainly I think people are still employed, and until that changes, they're going to spend money, and they're going to spend money on experiences and less money on stuff. which unfortunately the stuff part's what kind of drives our economy at this point.
Yep, agreed.
So I thought, just some interesting things. This is, like I said, something I follow on a monthly basis. I really enjoy, the way they present that, and it makes things relative, but thanks for pulling that one thing out on the jobless, initial jobless claims. It's amazing. I mean, it's 200,000 more than we were in 2019, which was a pretty dang good economy.
Right. But, the politicians, they look at the number itself, because that's
Yeah.
the headline number, whether they see up or down. You got to dig into it. Even labor participation rate, which is a conversation for another time, is also something to look at too, because that's deep in the weeds, and many of the other numbers that kind of aren't flushed out as well.
Totally agree. So you had kind of some market stuff on the yen, I think you said, that you wanted to cover.
Let me get in here. See my screen? Or
I do.
okay. So last week, so people realize that we're not fudging around with the charts here. So this is where we were last week when after the Fed announced, and I kind of look for a target down here. Now this is as of this morning. The big thing is that this is the S&P 500, so the broad market. Even though everything I just went through about the benchmark, this is what people are looking at. The ceiling for this has been basically 4,200. Well, this is the 50-day moving average. This is the 200-day moving average. What you really have to see here is, are we going to go below those two averages? And if we go below that 200 and more, and basically going really below 4,000, I think, we'll hit that price target of around 38.50 sometime in mid to late June. I think you're dead on about the debt ceiling. I think as we get closer, I think the banks and other people are going to get more spooked, and we'll have to see. I'm not wishing for it, but that's just really what we see, and how you have to plan accordingly. If you're looking to retire in the next 2 to 3 years, you really need to think about how to protect your portfolio. But most of the earnings announcements have come out at this point, at least most of the major ones. Disney came out yesterday, not so great. Their subscriptions were down for Disney Plus. So, all that money all these companies are put into streaming. Disney was down, Paramount was down. We got to see where Netflix is, because, content is king. And, if the consumer isn't going to pay for it, they're not going to pay for it. And a lot of these companies are going to have to rejigger, their vision of where they really see things are going. So it should be interesting.
Well, and it's interesting to me, especially I see with Disney. Disney bought out Marvel, Disney bought out Star Wars, and, what had always been, every Star Wars movie that came out, everybody was clamoring to. I remember, from the time I was in, whatever grade in 1976, I couldn't wait to go see the Star Wars movie, and nobody knew what the hell Star Wars even was. And then, every movie that came out was such an event. And then, Disney takes over, and it's like, man, how could we make more money? Let's just cram one of these down your throat every single year. And it's not an event anymore. And quite frankly, I don't really understand where each of the movies fits into the whole thing anymore. So I don't think I've seen the last 3 of them.
Hey, look, for what they paid for Marvel and George Lucas for the rights to everything, they got to squeeze the juice out of the orange.
I know they do.
Those movies have been horrific, very disappointingly, but they have been terrible.
And I think the other part is the theme parks. They have just gone off the charts crazy on prices and things like that. I was talking to our UPS guy that comes here, every day, and he and his wife just went to the one in California, and you had to get a reservation at the Star Wars bar. So basically it's the Star Wars bar at, from the first movie. And, so you had to get a reservation to get in there and all that. He said they walked out of there with a $250 tab for food and drinks at this, just this experience. And it's like, okay, I'm sorry, I've already paid, I'm paying like $300 a day or something like that just to go to the parks. And then you want to hit me for a $200 bill on top of it.
Hey, they got a captive audience. They don't want you leaving the property.
That's it. And so, I think that's going to be, I think the next shoe to drop for Disney is, economy slows down. They're going to price themselves out of the market and people are just not going to come.
I agree. We'll have to see how things progress as we go forward.
So it's interesting. So, I totally agree with you. I think where you're at on this, I personally see us going into next month. The more the debt thing drags on, the markets are going to get spooked and it's very likely to pull back. I look at my portfolios today. I mean, I've not really participated in the upswing this year because our portfolios really don't have much in the way of finance or tech in them right now. We've pulled back on that. I pulled back on that months ago. And, I think it'll play into my world pretty well eventually. But when 6 or 7 or 8 companies are the ones that are driving the whole show, it's just not good. It's never good. It ends up,
and they all had very good earnings too.
Yeah, they had phenomenal earnings, and they've cut costs by laying people off and everything else. So they're doing everything they should be doing. But they've kind of outrun their PE ratios at this point, and it's a time that it's likely that they're going to do a little bit of a pullback. If we see interest rates spike up again, that's interesting. I think one of the charts that I was reading with First Trust, if you looked at this last week, you saw it was kind of a weird barbell. You had the rates of the short term going up really significantly, the 3 and 6 month treasuries, and the 30-year treasury went up almost 9%, and so, or 9 points.
I didn't look at it today. Did you see the 1 month treasury? 5.4.
Jeez. 5.4.
If you have money in your bank account, why would you keep it there? Let's say if you need it in 30 or 60 days, why would you keep it in your bank account when you could throw it into a 30-day treasury for 5.4+%?
Which is totally liquid, and I could sell tomorrow and have the money in a day.
Asset protected. Yeah.
Asset protected. The federal government. I think the scare is, in the short term, if I need to redeem it, I wouldn't be able to redeem it because the government's not going to pay. Well, okay, the government's going to figure out a way to pay it. I'm sorry.
There are many things that you could always use the word catastrophic.
Yeah.
It would be catastrophic if they didn't pay the treasury.
Yeah.
They'll cut back in other areas, but that's their lifeblood, because if they didn't pay on the treasuries, the world would dump our money.
Yeah.
Because that's the security, that's our lifeblood to make sure that our economy runs across the board.
I think they talk a big game, but we're not going to default. We're going to end up, like you said, it's very likely that they'll go into some type of government shutdown. And I hope that it doesn't last 3 to 4 months, but I have lost more hope in our politicians than and both sides of the aisle, not just one side of the aisle. I've lost hope. I've lost hope in their ability to actually act like adults anymore. And it's just, I'm going to sit in the corner with my arms folded, and I'm not going to talk to you, and I'm not going to deal with you. And until
I'm going to take my ball and go home.
Yeah. I'm going to sit over here and I don't want to play anymore. Well, okay. We all have to negotiate. We all have to figure out what we can agree on. And there's hopefully more things that we agree on than we disagree. But it just seems like these big football topics, they just cannot figure out a way to agree on it. And, if it falls into a government shutdown, it falls into a government shutdown. Somebody's going to blink, but it's just, all it does is cause havoc for all the rest of us.
Well, the podcast discussion will get more interesting as we get closer to that June 1st-ish time frame. We will not be want for topics to talk about at that point. So. Definitely not.
Well, cool, man. Thanks for your piece of it, and good discussion today. So folks, we're doing these every week to keep on track with what's going on. We're also supplementing some things. I did a quick little episode. Last week we talked about we talked about a couple topics, and I did a couple little short, just here's what this means to you type of stuff. So make sure you check out the channel, subscribe to the channel, And make sure you hit the little bell icon, because that will tell you, it'll shoot you an email and let you know when we put stuff out, because we do put stuff out, at different times, just to give you a quick little education on all that. And it's meant to educate you and be there. If you have the opportunity, please share this with somebody and also comment below. So make sure that you give us a comment, tell us what you want us to talk about, because we're more than glad to do that every week. So thanks a lot, and we will see you guys back here the very next time.